In the spring of 1587, a line of merchants moved slowly across the marble floor of the Rialto district in Venice. The morning light filtered through narrow windows and fell across a long wooden counter inside a public office near the market. Each merchant carried not chests of coin, but folded papers, orders written in careful script. Behind the counter, clerks entered figures into ledgers and adjusted balances with strokes of ink. No silver changed hands. A spice dealer transferred funds to a shipowner bound for Alexandria. A wool importer settled a debt owed to a Florentine factor. A tax farmer deposited revenue collected along the Brenta River. The transactions were recorded, sealed, and confirmed. Outside, the canals were thick with traffic. Inside, value moved silently between accounts. It was a modest room, but it marked a turning point. Venice had created a public bank where money existed primarily as an entry in a book. The city did not arrive at this arrangement by accident. For centuries, Venice had been a trading republic balanced precariously between empires. Its wealth depended on ships that sailed to Constantinople, Beirut, and Alexandria, returning with pepper, silk, and grain. These voyages were long, seasonal, and expensive. Merchants required credit before ships departed and liquidity when they returned. Coinage, however, was unreliable. Silver supplies fluctuated with mining output in Central Europe. Gold ducats, one of Venice's proudest monetary achievements, circulated widely, but they were hoarded in times of uncertainty. Foreign coins flooded the city, clipped and worn. Weighing and testing metal consumed time and introduced friction into every large exchange. At the same time, the Republic's government faced its own constraints. Venice financed wars against Genoa and the Ottoman Empire not with sudden windfalls, but with forced loans from its citizens. Beginning in the 12th century, these loans were consolidated into a public debt known as the Monte. Citizens who contributed received claims on future tax revenues. Those claims could be bought and sold. A new kind of asset had emerged, an obligation backed by the state, transferable between private parties. The trading empire required constant motion, yet its monetary foundation was heavy, metallic, and slow. As commerce expanded in scale and geography, the limitations of coin became more pronounced. Merchants needed a way to settle accounts without physically transporting bullion across contested seas. The state needed a stable structure to manage its debt and to ensure confidence in repayment. Out of these pressures, Venetian banking evolved, not as a sudden invention, but as a gradual assembly of institutions. Private bankers, known as banchieri, had long operated in the city. They sat behind wooden benches in the Rialto, accepting deposits and facilitating transfers between clients. A merchant could deposit coin with a banker and instruct him to credit another merchant's account. Payment became a matter of book entry rather than metal exchange. Trust rested on the banker's reputation and solvency. But private banks were fragile. When one failed, as several did in the 14th and 15th centuries, the effects rippled through the trading community. Depositors rushed to withdraw coin. Credit froze. Commercial confidence wavered. Venice responded in 1587 by establishing the Banco della Piazza di Rialto, a public bank under state oversight. Deposits were backed not by speculative ventures, but by the credit of the Republic itself. Later, in 1619, the Banco del Giro expanded the system, allowing broader use of giro transfers, payments executed by moving balances from one account to another within the bank's ledger. The mechanics were straightforward but transformative. A merchant deposited coin at the public bank. In return, his account was credited with an equivalent amount of bank money. When he wished to pay another party, he issued an order. The clerks debited his account and credited the recipients. Large payments could be completed in minutes without a single coin leaving the vault. Balances held at the bank became more desirable than loose coin. Bank money was stable, standardized, and accepted for major transactions, including certain taxes. Because transfers occurred within a closed ledger system, the need to verify each coin's weight and purity disappeared. Settlement risk declined. The state benefited as well. By concentrating deposits, the Republic strengthened oversight of liquidity within the city. Public confidence increased because the bank operated under strict rules. It did not engage in risky lending. It maintained substantial reserves. Its books were transparent to government supervisors. Risk did not vanish, but it shifted. Instead of depending on the solvency of numerous private bankers, merchants relied on the fiscal stability of the Venetian state. That state, in turn, was supported by diversified trade revenues and a disciplined political structure dominated by merchant families who had a direct interest in preserving credibility. The system scaled because it aligned incentives. Merchants wanted reliable settlement. The state wanted stable finance. The bank became the hinge between them. As this machinery matured, the effects extended beyond the Rialto. Venetian merchants could coordinate complex, multi-leg trade routes with greater efficiency. A shipment of pepper purchased in Alexandria could be financed through credit arrangements settled in Venice without requiring constant bullion transfers. Insurance contracts, maritime partnerships, and public debt instruments all circulated in a financial ecosystem lubricated by ledger-based money. Capital began to move with fewer physical constraints. Investors could hold shares in the Monte and transfer them as needed, using bank balances as a medium of exchange. Wealth became increasingly abstract, measured in claims, credits, and obligations rather than in chests of coins stored in cellars. Venice did not invent every element of banking. Italian cities such as Florence and Genoa had pioneered bills of exchange and deposit banking earlier. What distinguished Venice was the durability of its public institutions and the integration of banking with state finance. The Republic formalized the relationship between sovereign credit and commercial settlement. This integration stabilized power. Even as Venetian naval dominance waned in the 17th century, its financial credibility endured. The city could borrow at comparatively favorable rates because investors trusted its administrative discipline. Public debt was not a temporary emergency measure. It was a structured, tradable asset embedded in civic life. Other European states observed closely. The idea that government debt could be consolidated, serviced through dedicated taxes, and supported by a reliable banking mechanism traveled north. In the late 17th century, the Bank of England adopted similar principles. Public debt management intertwined with deposit banking and ledger transfers. Amsterdam's Wisselbank operated with comparable emphasis on stable bank money and full reserves. The pattern was clear. Financial strength no longer depended solely on metal reserves or conquest. It depended on credibility, record-keeping, and institutional continuity. Over time, the tools refined in Venice became foundational to modern banking. Deposit accounts, giro transfers, public debt securities traded among citizens, state-backed financial institutions designed to anchor trust. The architecture remains recognizable today, even if the scale has changed. Modern central banks maintain electronic ledgers rather than inked books. Governments issue bonds that circulate through global markets instead of within a single lagoon city. Payments move at digital speed rather than by written order across a marble counter. Yet the logic is similar. Value recorded as trusted entries, transferable without physical exchange, underwritten by public authority. Venice's system did not eliminate crisis or decline. By the 18th century, trade routes had shifted toward the Atlantic. The Republic's geopolitical influence diminished, but its financial innovations outlived its maritime empire. They demonstrated that a state could convert its fiscal obligations into a stable financial instrument, and that commerce could expand when settlement became predictable. The transformation was subtle. No single decree announced the birth of modern banking. It emerged through adjustments, responses to coin shortages, war financing, merchant risk, and institutional failure. Each reform addressed an immediate constraint. Together, they formed a durable structure. The city itself reflected this quiet evolution. Behind the ornate facades and crowded quays lay offices filled with ledgers. Clerks tallied balances while gondolas passed beneath stone bridges. Contracts were signed in rooms overlooking narrow canals. Wealth accumulated not only in warehouses of pepper and silk, but in carefully maintained accounts. In the late afternoon, as the Rialto market thinned and the shutters began to close, a final series of entries might be made in the bank's register. A merchant's account debited, another credited, ink drying on parchment, coin resting undisturbed in vaults below. Outside, the tide of the lagoon rose and fell as it always had. Inside, numbers moved across a page, binding the fortunes of a republic to the trust embedded in its books. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.